you're going to lose some significant volume. If treasuries stay up here, we need to keep rates somewhat, manageable. And we try to negotiate the, spread being reduced. Funny story is Wall Street can do whatever they want. We had it verbally in place to basically reduce 15 basis points, on our spread on our DSCR loans. And then, of course, on Monday and this week, they said they need to wait and see what the treasuries do. And I guarantee you, by tomorrow, when we're supposed to hear back from them, that spread is no longer going to be offered because we got a 30 basis reduction in the treasuries.
Folks, I don't know if you heard, but on February 5th, home mortgage rates dipped below 7% for the first time in 2025. Now, we are recording this on February 6th, and I believe, if I had to guess, it will tick above or equal 7% at the end of the day. But hey, we have our first print below 7% for the day. Dustin, that's big news, I think.
Yeah, 100%. I think it's something that we can finally in 2025 kind of have some hopium built into our system with regards to, going into 2025. We had the 10-year treasury, I think we were just saying it right before this, touch 4.8 or 4.79, whatever it was, which is basically 120, 130 basis points higher than what it was in October. So It's been a fun ride from October to January, right? But to see the 10-year break below 4.5, there was if you're a market sentiment investor, trader, etc., breaking below the 4.5 was a very important, piece of the puzzle. Now, don't get me wrong, we've seen this, at least on my time on this channel with this community, in that type of change and being excited to only be let down a week later or a day later, specifically with job reports tomorrow, right? Which is important.
Big one.
But it's something good to talk about. It's something to realize that I think the most important part that people need to understand is mortgage rates fell below 7.699, we'll call it, because it wasn't like it went to 6.8 or something.
Hey,
but
it had a 6 on it, man. Stop it. Stop taking away the hopium.
Yeah, we'll take it. And that's simply because of the treasury coming down, or the treasuries, the 5 and the 10 years specifically, with Trump's administration, confirming that they're not going to focus on battling the feds like we thought. The Godzilla versus, what is it? What's the what's the two
Hong Kong and Godzilla?
Thank you. That's kind of the memes you would see, and it's clear that he's going to focus more so on the 10-year treasury. And
I think that's huge news. I don't think that
huge.
I think that is game changing, because again, as I've said for quite a while, guys, you're focused on the wrong thing, right? Stop beating up the Fed. The Fed's already delivered 100 basis points and rates went the wrong way. You want the Fed to cut lower and rates to continue going higher? What are you doing? So the fact that Scott Bassett, the new Treasury Secretary, has come out and said, we are focused on the 10-year. That's game changing, because again, the things that Trump's administration can do, deregulation, oil, energy costs, tax cuts, all of these things, that can
deficit
lead
reduction.
to deficit. That's the magic. Deficit reduction. If we could come in and just bend the curve a little bit, the market, the smart money, will buy ahead of that.
Yeah.
And you could see 10 years crash. The rates crash, which means prices go up. Just that's a bond thing, but it's a home run. The focus is on the 10-year, not the Fed. Game changing.
Yeah, and bending the curve is huge. We've kind of seen it flatten out and slowly go to the way it should be, which is a very, slow but uphill. If you're looking at a chart, right, from left to right, you want the yields on a longer term bond to be higher than the shorter term. And we obviously didn't have that in 23 and 21, and it was inverted. But if we can get that, bent in the right direction, specifically, like you said, with ultimately, I think maybe it was 2 weeks ago you brought it up, and I agree with you. Like, oil is going to be the first domino.
Yep.
And I just want to see if, a lot of the market is buying into the sense vision of, pushing down inflation and longer term rates, which hopefully means we may see some more strength in the mortgage bonds and better rate sheets for the next 2 months, three
Yeah.
months, and year, and whether it's 25 or 26. I think there is a chance now
Yeah. Yeah.
higher
So
than it was, a
yeah.
month.
Yeah. So when I look at all of this, I think it's all a huge net positive. But I do want to remind folks that the stuff we're talking about takes time, right? So while all of this is net goodness and some of it's really good, I still don't see it helping us in the first half of 25. It might have some slight positive impact on the second half of 25, but I think it becomes a strong net positive. I mean, here's a crazy idea I haven't said, but I think the 10-year might have a 3 handle on it in sometime in 2026.
As of
That's what
today,
I,
yeah, that's the path. Who's sitting in the sitting in the White House right now wants to get to, right?
yeah,
So
exactly. Yeah.
very plausible, but like you said, it's not going to be super quick, and it's not something that we've seen in the last 2 years where rates can move up and down a full percent. That's not happening this go around,
Mhm.
right? But getting to something 3.8, 3.9
Yeah, let's
is
play
very
with that. So
possible.
let's just do some fun, real easy math. Let's just say it's 3.8. And right now the spread is about 2.5, I think. So that would mean mortgage rates rough and tough, just a wild ass guess if I'm right, about 6.3. However, if we go with 3.8 and then we go to the long run average, let's just say 1.9, dude, you could have mortgage rates at 5.7, right? Now, again, I don't think the spread collapses that much in 26, but it might happen in 27. This is a series of events, a series of dominoes that play out. And I think you're right. I think oil is the first one to kind of be a net positive going to $60 a barrel. But we could be in a vastly different market in 26, and then 27 is better than 26. This is why I keep telling people in real estate and in mortgage, 2025 is your last hard year. 26 will be better than 25. 27 will be better than 26. Survive through 25. Let your competition and the weak players become baristas. And then you're going to gorge in 26 and 27.
No, I completely agree with that. The you made me think of when you brought up the spread, of course, between the 10-year and where the 30-year mortgage rate is. I think I talked about this 2 or 3 weeks ago on our interview where me and John were negotiating with one of our funds for
Yeah,
our DSCR non-QM rate sheets to get the spread down because the treasuries were so high at the 4.79, 4.8 range where it's like, guys, we're going to lose some significant volume if treasuries stay up here. We need to keep rates somewhat, manageable. And we try to negotiate the, spread being reduced. Funny story is Wall Street can do whatever they want. We had it verbally in place to basically reduce 15 basis points, on our spread on our DSCR loans. And then, of course, on Monday and this week, they said they need to wait and see what the treasuries do. And I guarantee you, by tomorrow, when we're supposed to hear back from them, that spread is no longer going to be offered because we got a 30 basis reduction in the treasuries
yeah,
in the last week
shocking.
and a half. So there's the fact, but the moral, I shouldn't say the moral of the story. The reason I brought that up is because, historically, let's say 1.8 or 1.9, the spread between 10-year and 30-year, right? There's a big cushion still, and there's a lot of moving pieces or levers that can be pulled to
Yes,
get rates to the five ranges, high fives, low sixes, mid sixes, other than just having the treasuries drop, right?
correct.
Because
The
there's
margin is there. Yep.
still, yeah, and they need to be fed, and they know that they can reduce that spread a little bit and get fed
Well,
more that way rather than
yeah,
waiting on treasuries.
I love that you brought that up because one of the things that you will see on you're going to see it on Wall Street first. That's just they move that fast. Is if they notice that volume of DSCR loans in this example start to fall or frankly collapse, they're going to be running around with their heads cut off going, how do we get it? How do we get it? You got to collapse the margin, buddy. I mean, it's that simple.
Yeah, I mean, it's an easy lever for them to pull because they were ready to do it, and we had it good, and it was looking good, and either way, look, right now, DSCR, non-QM rates, and all the emails I'm sure some of the audience is getting about massive rate drops, rates are cutting, all
Yeah.
that in the last week. Because we get the screenshot sent to us being like, did
Yeah.
your rates collapse? Are they down to the six? They have come down, but that's
Yeah.
part of it. And now we're still seeing like this is crazy. Yesterday we put out like a quote sheet for one of our realtor partners on a 4 unit in LA with like 2.5 points on conventional. You're getting down to 5.8. So to
Wow.
say 5 on an investment property, specifically a 2 to 4 unit property, to have a 5 handle in front of it's crazy.
No
This is a
kidding.
30-year fix, right? It's not a 6 month
30-year
arm.
fix
Yeah,
sub 6.
2.5 points, sure,
Yeah. Yeah. I
but
mean, that's
you can
awesome.
say 5 now, which
Yeah.
is crazy.
And oh, by the way, you can get the seller to pay for the points.
How about that?
How
Huh.
about
Oh, did we just go? Okay. I may have, if it got,
this is amazing. Oh, he's back. Technology. Oh, I think we may have lost him. Dustin, you're amazing, man. Go to convoyhomeloans.com, click on ORaaT. We'll talk to you guys later.